Most traders believe more effort creates more profit. More charts, more indicators, more trades, more opinions, more action. But what if that instinct is exactly what keeps them poor? What if the path to greater profit is not adding more, but following one rule more faithfully than everyone else? That is where serious trading begins. Not with prediction, not with excitement, not with constant activity. With one rule, and here is what most people miss: the rule itself is often simple. The difficulty is not understanding it. The difficulty is obeying it when money is on the line. Have you noticed that? Have you ever made a clear decision before entering a trade, only to betray that decision the moment price moved against you? Of course you have. Every trader has. That moment tells you something important. Trading is not mainly a battle against the market. It is a battle against your own changing mind. The market moves. That is its nature. Your emotions move with it. That is human nature. Profit comes when your rule does not move. Think about that. When price rises, greed whispers that you should hold longer. When price falls, fear tells you to escape early. When you miss a move, frustration pushes you into chasing the next one. When you lose, revenge tempts you to trade bigger. Now ask yourself, where is your rule in those moments? If it disappears under pressure, then it was never a rule. It was only a preference. And preferences do not survive markets. Rules do. This is why disciplined traders often look boring from the outside. Their decisions are not dramatic. Their process is repetitive. Their behavior is steady. They wait. They act only when conditions align. Then they manage risk without negotiation. Simple. But not easy, because the mind hates waiting. The mind wants certainty where none exists. It wants action to relieve tension. It wants to feel involved. Yet markets reward patience far more than activity. Why? Because opportunity is not constant. That is the first observation worth understanding. Deeply markets spend much of their time doing nothing useful for your strategy. Read that again. Much of what happens on a chart is noise, random movement, emotional reaction, short-term confusion. If you trade every movement, you place your capital inside randomness. Then you call it bad luck when outcomes become random. But was it luck or lack of selectivity? A trader with one strong rule learns to separate movement from opportunity. He asks, what is price doing? Then why is it doing it? Then does this match my condition? If not, he waits. Can you do that? Can you sit still while the market moves without you? Can you watch opportunity pass and remain calm because it did not meet your rule? That restraint is profit, though it does not feel like profit in the moment, because every bad trade avoided protects capital. Protected capital creates staying power. Staying power allows participation in high-quality opportunity. High-quality opportunity produces better results, because leads to effect. That is how professionals think. Now let's go deeper. Your one rule must not be abstract. It must be visible, concrete, repeatable. For example, maybe your rule is this: I only trade when price confirms strength after a clean consolidation. Now you have something real. What do you look for? You look for compression, tight price behavior, shrinking volatility, clear support holding. You watch volume behavior. You observe whether weakness is being bought quickly. You look at how price reacts near important levels. Then comes expansion. Price breaks with intent, not hesitation. That is behavior. Behavior tells truth faster than opinion. Or maybe your rule is risk-based. I never risk more than 1% on any idea. Simple, but powerful. Why? Because survival changes everything. A trader risking too much becomes emotional because every trade feels personal. Fear increases. Decision quality falls. Mistakes multiply. Losses deepen. But controlled risk creates psychological stability. Stable psychology creates better execution. Better execution creates consistency. Again, cause and effect. Do you see the pattern? The market is not random chaos to the disciplined eye. It is behavior creating consequence. Your job is to recognize the chain before it unfolds. Look at traders who fail repeatedly. Their habits reveal everything. They enter too early because they fear missing out. They hold losers because they fear being wrong. They cut winners quickly because they fear losing open profit. They size too large because they crave fast progress. Fear. Fear. Sometimes dressed as confidence. Sometimes disguised as conviction. But underneath, fear. And here is the quiet truth. Many never learn confidence in trading does not come from winning. It comes from following your rule, regardless of outcome. That sounds strange at first, doesn't it? Shouldn't winning create confidence? Not necessarily. A reckless trade can win money and build dangerous habits. A disciplined trade can lose money and strengthen professional behavior. Which one improves your future? The second one. Always. Because trading is not measured by one outcome. It is measured by repeated quality decisions across many outcomes. That is where wealth is built, in process, not impulse. So watch yourself closely. Not just your chart, your reactions. When you feel urgency, pause and ask, is this my rule or my emotion? When you want to average down, ask, has the original condition improved, or am I simply uncomfortable taking a loss? When you want to chase momentum late, ask, am I reading strength or reacting to excitement? Questions create clarity. Clarity protects capital. Capital creates opportunity. Opportunity creates profit. And slowly, something changes inside you. You stop trying to conquer the market. You begin learning to govern yourself. That is when trading becomes quieter, cleaner, sharper. You realize that more profit often comes not from finding more setups, but from following one rule more precisely, more patiently, more honestly than before. One rule with deeper discipline. One edge with stronger execution. One method with less interference. That is enough, more than enough, if practiced well. Because the great advantage in markets is rarely secret knowledge. It is uncommon consistency. And consistency is built in moments nobody sees. When you choose not to trade. When you accept a small loss without protest. When you refuse temptation. When you wait 1 hour longer for confirmation. When you hold steady while noise tries to pull you away from your plan. That is where your edge grows. Quietly. Repeatedly. And once you begin to understand that, a new question appears. The question that separates casual traders from serious operators. If one rule followed with complete discipline can transform results, then what would happen if every decision, every entry, every exit, every moment of pressure was filtered through that same unwavering standard? Most traders think profit comes from action. They believe movement creates money, so they stay busy, watching every candle, reacting to every headline, chasing every sudden move. Their hands are always ready, their minds always racing, their emotions tied to every tick on the screen. Yet the strange truth is this: the market rarely rewards urgency. It rewards patience. That sounds simple, but patience in trading is not passive. It is not laziness. It is not hesitation. It is disciplined waiting while everything inside you wants to act. Have you ever watched a chart and felt that quiet pressure building inside you? Price starts moving. Volume picks up. The market looks alive. Suddenly your mind begins whispering, this is it. Don't miss it. And without enough confirmation, without your setup fully forming, you step in early. Not because the opportunity is clear, but because waiting became uncomfortable. That is where patience breaks. And when patience breaks, judgment weakens. The impatient trader enters on hope. The patient trader enters on evidence. That difference changes everything. Patience allows price to reveal intention. It lets false breakouts expose themselves. It gives weak momentum time to fade. It shows whether buyers are truly committed or simply reacting. Markets often tempt traders with half-formed signals, little flashes of excitement that look like opportunity, but lack strength underneath. If you move too quickly, you become part of the trap. If you wait, the trap becomes visible. That is why patience protects capital before it creates profit. A rushed trade usually carries poor entry, weak conviction, and emotional management. Because it was entered too soon, every small pullback feels threatening. Fear grows. Decisions become reactive. A manageable trade turns into stress. But when you wait for alignment, clear structure, confirmation, volume, behavior matching your rule, you enter with understanding, not impulse. That creates calm. Calm improves execution. Better execution improves consistency, because creates effect. Patience is not about waiting forever. It is about waiting correctly. There is a difference. Some traders wait in fear, afraid to act. Others wait with observation, studying behavior, reading pressure, watching how price responds at important levels. That kind of patience sharpens your eye. You begin noticing details impatient traders miss. Failed pushes, Exhausted momentum, strong rebounds, tightening ranges, silent accumulation. You stop seeing candles as noise and begin seeing behavior, and behavior speaks clearly to the patient mind. Patience also changes how you hold winning trades. Many traders can wait for entry, but few can wait inside profit. The moment price moves in their favor, they rush to lock gains because open profit creates anxiety. They fear giving anything back, so they cut strength too early. Then they watch price continue without them. Again, impatience steals what skill created. The patient trader understands that good trades need room. Strong trends breathe. Healthy moves pull back. Momentum expands, pauses, and expands again. If your analysis was sound, patience allows the trade to unfold. Not every winner should be grabbed quickly. Not every movement needs your reaction. Sometimes the best decision is to do nothing while your position works. Can you sit still when nothing exciting is happening? Can you wait through silence without forcing action? Can you trust preparation more than impulse? That is where profit quietly begins to separate itself from noise. Because markets are built to test impatience. They flash opportunity where there is none. They create boredom so traders manufacture trades. They create fear so traders abandon plans. They create excitement so traders chase at the worst possible moment. The patient trader sees this and remains steady. He knows there will always be another setup. He knows missing one move is harmless, but forcing 10 bad trades is expensive. He knows that waiting is not lost time, it is selection. And selection is edge. Most traders are taught, directly or indirectly, that more trades mean more opportunity. More setups watched, more buttons pressed, more chances taken. Surely that should lead to more profit. It sounds logical. It feels productive. But in trading, what feels productive is often what drains accounts the fastest. More trades usually do not mean better decisions. They mean more exposure to weak setups, more emotional swings, more unnecessary risk, and more mistakes disguised as activity. Have you ever looked back at a week of heavy trading and noticed something uncomfortable? Out of 20 trades, maybe only 3 or 4 were truly solid opportunities. The rest were average entries, impulsive reactions, revenge trades, boredom trades, or positions taken simply because sitting still felt difficult. That is how quantity quietly destroys quality. The market offers movement every day, but meaningful opportunity is rare. Price is always moving, yet not every movement deserves your capital. Some moves lack structure. Some have no clear direction. Some are driven by noise, emotion, or sudden reaction that disappears as quickly as it came. If you treat every movement like opportunity, you stop trading with judgment and start trading with appetite. And appetite is expensive. The disciplined trader understands something most never learn: selectivity creates edge. He is not trying to trade every wave. He is waiting for his wave. That changes everything. Because when you become selective, your standards rise. You stop entering because something looks interesting. You enter because it matches clear conditions. The setup must earn your money. Price must prove itself. Structure must be clean. Risk must make sense. Timing must align. If one part is missing, you pass. Can you do that? Can you let a market move without you because it was not your trade? Can you stay calm while others chase action? Can you accept that discipline sometimes looks like doing nothing? Most cannot. That is why they overtrade. Overtrading rarely begins with greed. It begins with restlessness. The mind wants involvement. It wants to feel active. Watching without acting feels unproductive, so traders force decisions just to escape inactivity. But forced trades carry weak conviction, and weak conviction creates emotional management. Second, guessing entries, exiting too soon, moving stops, adding risk where there should be caution. One bad trade leads to frustration. Frustration leads to another rushed trade. Then comes revenge. Then damage. Cause creates effect. Fewer trades interrupt that cycle. Fewer trades mean more patience in selection, more attention to execution, and more emotional energy reserved for moments that actually matter. You begin treating capital like ammunition, not confetti. Every shot has purpose. And when every shot has purpose, your thinking becomes sharper. You study more carefully. You wait more calmly. You act with greater clarity. Even your losses improve. A carefully selected losing trade teaches valuable lessons because it was based on sound reasoning. But a reckless losing trade teaches little beyond what you already knew, that impatience has a cost. That lesson becomes expensive when repeated. The strongest traders are often not the busiest traders. They are often quiet, deliberate, almost restrained in their behavior. They may sit through hours, even days, doing nothing because nothing meets their standard. Then when the moment comes, they act decisively because preparation has already been done. Less action, better action. That is where real progress begins. A good trading system can be ruined by a single emotional decision. That is the hard truth many traders avoid. They spend months searching for better strategies, cleaner indicators, sharper entries, and stronger confirmations, believing the flaw is in the method. But often, the method is not broken. The trader breaks it. Emotion does. Have you ever entered a trade exactly according to your plan, only to panic at the first pullback and close it early? Then, moments later, watched price move exactly where you expected. That was not a strategy failure. That was emotion interfering with execution. This happens because money changes behavior. The moment capital is at risk, logic begins to compete with feeling. Fear grows louder than analysis. Doubt appears where confidence once existed. Suddenly, a plan built with a clear mind gets managed by an anxious one, and anxious minds make expensive decisions. Fear cuts winners short because open profit feels fragile. Greed stretches losing trades because closing them makes loss feel real. Hope convinces traders to hold positions that no longer make sense. Frustration creates revenge trades, fast, impulsive decisions made not from opportunity, but from wounded pride. One emotional decision rarely stays alone. It creates another, then another, because becomes consequence. A trader moves a stop loss because he believes price will come back. Price falls further. Loss deepens. Anger builds. To recover quickly, he increases size on the next trade. That trade is rushed. It loses too. Now discipline is gone completely, replaced by reaction. What began as one emotional mistake becomes a chain of destructive choices. That is how accounts bleed. Not from one big disaster, but from repeated emotional leaks. The market understands human weakness better than most traders understand themselves. It creates uncertainty, and uncertainty stirs emotion. Sharp drops trigger fear, fast rallies trigger greed. Choppy movement creates frustration. Long waiting periods create boredom. Every condition presses on the mind differently. If your emotions control your decisions, the market controls you. Can you recognize your emotional signals before they become actions? Can you feel impatience rising and still remain still? Can you accept a loss without trying to immediately win it back? Can you watch profit pull back slightly without rushing to protect every dollar? That is emotional control, and emotional control protects every good system. The strongest traders are not emotionless. They feel fear, excitement, disappointment, and doubt like everyone else. The difference is they do not obey those feelings. They let rules make decisions where emotion wants influence. They trust process over impulse. They understand that temporary discomfort is often the price of long-term consistency. Because feelings change quickly, rules stay steady. This is why preparation matters before entering a trade. You must know where you enter, where you exit if wrong, where you take profit, and why the trade exists at all. Decisions made in calm conditions are usually sound. Decisions made in emotional heat are usually compromised. Clarity before action prevents confusion during pressure. Without that clarity, every market movement feels personal. Every candle creates doubt. Every fluctuation invites reaction. Trading becomes emotional noise rather than disciplined execution, and noise breaks systems. One strong method, followed consistently, can build remarkable results over time. But if fear edits entries, greed changes exits, and frustration alters risk, even the best method becomes powerless. Emotion does not need to destroy your whole system. It only needs to bend it slightly. Most traders enter the market thinking about how much they can make. They measure opportunity by reward, dream about large moves, and focus on profit before anything else. It sounds natural. After all, why trade if not to make money? But that way of thinking quietly creates weakness. Because when profit becomes the first thought, protection becomes an afterthought. And in trading, what you fail to protect is eventually what you lose. The market does not reward ambition without discipline. It does not care how confident you feel, how strong your conviction is, or how certain your analysis appears. Price can move against the smartest idea, the cleanest setup, and the most convincing story. Uncertainty is built into the game. That is why serious traders think differently. Before they ask, "How much can this make?" they ask, "How much can this cost?" That single shift changes behavior. Have you noticed how careless decisions often come from focusing too much on reward? Traders see a large target and suddenly risk starts feeling smaller than it really is. Stops widen, position size grows, caution disappears. The mind becomes attached to what could be gained and blind to what could be lost. That is where danger begins. Protecting capital means respecting risk before excitement has a chance to speak. It means knowing exactly where the trade becomes invalid. It means accepting small losses without negotiation. It means keeping position size controlled even when confidence is high. It means understanding that survival matters more than proving a point. Because capital is not just money, it is opportunity. Without capital, skill has nowhere to act. Without capital, patience becomes useless. Without capital, experience cannot compound. A trader who protects capital stays in the game long enough for edge to work. A trader who ignores protection eventually becomes a lesson in what not to do, because creates consequence. One oversized loss damages more than your account. It damages confidence. It creates hesitation on future setups. It increases emotional pressure. It can make a disciplined trader fearful, or turn a fearful trader reckless. Losses become heavier when they were preventable. Small controlled losses, on the other hand, carry very little emotional weight. They are accepted. They are expected. They are managed. And because they remain small, recovery stays realistic. Can you take a loss without making it personal? Can you close a trade exactly where your rule says, even when hope whispers that price might come back? Can you keep risk small on your best, looking setup, knowing certainty does not exist? That is real discipline. Many traders think protecting capital slows growth. In truth, it creates growth. When losses stay small, gains matter more. When drawdowns remain shallow, confidence remains stable. When confidence remains stable, execution improves. Better execution creates consistency. Consistency builds accounts far more reliably than occasional large wins followed by deep setbacks. Protection creates freedom. You stop trading with desperation because one trade cannot hurt you badly. You think clearly because your account is not under constant threat. You become patient because survival removes urgency, and from that calm state, better decisions naturally follow. The market always offers another opportunity, but only if you still have capital when it arrives. That is the quiet truth most learn late. The first job is not making money. It is staying strong enough to keep trading tomorrow. Excitement has emptied more trading accounts than bad analysis ever did. That may sound strange because excitement feels positive. It feels like confidence, energy, conviction, and opportunity all arriving at once. Price starts moving fast, candles expand, volume rises, and suddenly the mind becomes alert. Your attention sharpens, your pulse changes. A powerful feeling takes over, the fear of being left behind. And that feeling makes traders act too quickly, not because the setup is confirmed, because the setup feels exciting. That is where mistakes begin. The market knows how to create emotional urgency. Sharp moves attract attention. Sudden breakouts create buzz. Fast momentum makes traders feel they are watching something important unfold. But fast movement is not always strong movement. Excitement can be nothing more than temporary emotion flowing through price, and temporary emotion often fades as quickly as it appears. Have you ever chased a breakout because it looked unstoppable, only to watch price reverse shortly after you entered? Have you bought strength too late because everyone seemed convinced it would continue? Have you entered simply because standing aside felt uncomfortable? That is excitement replacing confirmation. Confirmation is quieter. It asks for proof, not emotion. It waits for price to hold above resistance, not just touch it. It watches whether volume remains strong after the move, not only during the first burst. It looks for structure, follow-through, and behavior that supports continuation. It asks whether buyers are committed or simply reacting in the moment. Excitement jumps. Confirmation observes. That difference separates impulsive trading from disciplined execution. When traders move on excitement, they often enter at poor prices. They buy extended candles near short-term exhaustion. They ignore weak structure because momentum feels convincing. They increase size because emotion creates false certainty. Then the moment price pulls back, as healthy price often does, fear appears immediately. Now confidence becomes doubt. Conviction becomes panic. A trade entered with excitement gets managed with emotion, because creates consequence. But when you wait for confirmation, your entire mindset changes. You are no longer reacting. You are evaluating. You enter with evidence. You know why you are in the trade. You understand where your idea is valid and where it is wrong. Small pullbacks feel normal because your decision was built on structure, not adrenaline. That creates calm. Calm improves decision-making. Better decision-making protects capital. Protected capital keeps you in position for real opportunity. Can you wait while price moves without you? Can you watch a strong candle and resist the urge to chase? Can you accept missing a move rather than entering without proof? Can you trust patience more than excitement? Most traders struggle there, because excitement feels like opportunity. Waiting feels like missing out. But often, what feels like missing out is actually protection. Markets constantly test emotional control by creating moments that look urgent. Noise gets dressed up as opportunity. Random spikes get mistaken for strength. Crowd excitement creates false confidence. If you trade every burst of energy, you become a follower of emotion rather than a reader of behavior, and behavior tells a deeper truth. Real strength holds. Real momentum builds with structure. Real breakouts defend important levels. Real opportunity gives evidence beyond a single exciting candle. That evidence matters, because trading is not about catching movement first. It is about entering when movement proves itself. Many traders admire brilliance. They chase clever strategies, complex indicators, and bold predictions. They look for the trader who catches exact tops, buys exact bottoms, or makes dramatic gains in a short time. Skill like that looks impressive. It attracts attention. It creates stories people remember. But markets do not reward what looks impressive. They reward what can be repeated. And repeated success does not come from flashes of brilliance. It comes from consistency. That is what many fail to understand. A brilliant trade can be luck, timing, or instinct that happened to be right once. But one strong outcome proves very little on its own. Trading is not built on isolated victories. It is built on habits that hold up over time, through different conditions, across many decisions. That is where consistency quietly wins. Have you ever seen a trader make one huge gain, only to lose most of it later? Have you watched someone celebrate a bold trade, then disappear after a string of reckless losses? That happens because brilliance often creates confidence faster than discipline can support it, and confidence without structure becomes dangerous. Consistency is different. It is less exciting from the outside, but far more powerful underneath. It is built on repeating sound decisions, taking setups that match your edge, managing risk the same way each time, accepting losses without emotional reaction, and staying patient enough to avoid low-quality trades. Simple actions, repeated well. That is where steady growth begins. Consistency creates trust in yourself. You know what you are looking for. You know how you act under pressure. You know your risk before entering. You know when to step aside. That clarity removes unnecessary conflict inside the mind, and a clear mind makes cleaner decisions. Because creates effect. When decisions become cleaner, execution improves. Better execution leads to fewer avoidable mistakes. Fewer mistakes protect capital. Protected capital gives your edge time to work. Over time, small advantages compound, not dramatically, but steadily. That steady growth often outperforms dramatic swings. Brilliance tends to reach high and fall hard. Consistency climbs quietly and holds ground. Can you trade the same disciplined way after a win? Can you stay patient after missing a move? Can you keep position size controlled when confidence is high? Can you follow your process after a painful loss without changing everything emotionally? That is consistency. It is not built in easy moments. It is built when emotion wants control and discipline quietly refuses. Many traders sabotage consistency because they become bored with what works. A simple strategy repeated well starts feeling too ordinary, too slow, too predictable. They begin searching for excitement, new systems, bigger trades, faster opportunities, and in chasing something better, they abandon what was working. That is the trap. Markets reward reliability more than creativity. They care less about how clever your idea sounds and more about whether your process survives pressure. The trader who does the basics exceptionally well often outlasts the trader chasing brilliance. Because fundamentals hold when emotions rise.